Hello and welcome to another exciting episode of the Accredited Investors Only podcast presented by Accredited Life. I am your host, Peter Neal. Thank you so much for being with me today. We have an amazing episode lined up with a really great guest. But before we get there, I always like to ask, are you living your accredited life? See, there's really two different ways that we can live life. We can live a normal life. I mean, we could just be the person we are and kind of just go with the flow and, whatever comes to us in life, whatever, we just kind of roll with the punches, that kind of thing. Or we can define what it is that we want. We can set goals, we can have dreams, and we can work towards getting there. So there's the person that you are today, there's the life that you're living today, and then there's the accredited life. There's the life that you want to be living. There's the life that, in 6 months from now, a year from now, 5 years from now, that has everything that you want it to have, and it's the life that you create it for yourself, where you have freedom, you have freedom of time, financial freedom, all that kind of stuff. So as always, we challenge you to live your accredited life through this podcast, through the community that we're creating. So here's the thing. You have to know, what is the life that I'm living today? And I challenge you to write down, what are you doing today? Self, health, wealth, all those things. Take pen to paper and write down, what's your normal schedule look like? What's your normal eating habits look like? Thinking habits, work habits, all that kind of stuff. Really start to write it down and reflect on what the life that you're living today, and then look at the accredited life. And you can call it whatever you want. For me, years ago, I've told this story before, and I won't get into it, right now too much. But, what that meant to me, living the accredited life, was when I first saw, what could be done through real estate investing, raising capital, buying, commercial real estate, residential real estate, all that kind of stuff. And the life that that could create for you, and the freedom it could create, the freedom at work, with controlling what you want to do, and that kind of thing, freedom of time and energy and money and that kind of stuff. And in my mind, I called it living the accredited life. So write down on the opposite end. This is kind of like your vision, where you want to be. Write down, what do you want the self, health, and wealth to look like? What do you want your relationships to look like? What do you want to look like, mentally, with how you think and how you react to things? What do you want your health to look like? What you're eating, how you're exercising, all that kind of stuff. Write those things down. And now all you got to do is just close the gap. Now, that's not an easy thing to do. It sounds easy, like anything, right? It sounds easy, but it's kind of complex to get there, right? But now that you have, here's the life I'm living today. Here's the person I am today. Here's the life I want to be living. Here's the person I want to be. Now you can see what you're missing. You can see how, the gap between those two, and what you need to do to kind of close that gap. You're going to have to make decisions, and that starts by defining what it is that you want. Even if you're not 100% about it, have a goal in mind and work towards it. And over time, that can evolve, that can change as new information comes in. The vision and the goals are going to be a moving target. You know what I mean? So don't get hung up on, well, I don't know if I want this, or I don't know if I want that. Pick what it is that you want and work towards that, and then find out from there. So you got to make decisions. You got to take action. You got to talk to people. You got to listen to podcasts. You got to read books. You got to go to conferences. You got to have lunches and dinners and breakfasts and coffee and all that kind of stuff. You got to take action and actually be working towards that every day. We all struggle with this in one of those levels with self, health, and wealth. And we can talk a lot about that. And I'll talk a lot about that in the community. We're always going to have kind of the things that maybe come easier to us naturally, things that we got to work more towards, because they don't come as easy to us, that kind of thing. So we got to make decisions, we got to take action, and we got to take it day by day. We have to start somewhere, and we have to take it day by day. We have to understand that living the accredited life isn't necessarily going to happen tomorrow, though. This is like what we talked about last week with reframing. If you're working towards it, life is a lot about the journey and all. So you can think about that differently too. But you got to take it day by day. You got to lay bricks each day, working towards that. Like I said, evolving, taking new information in, and at the end of each day, you have to say to yourself, was I moving towards it, or was I moving away from it? And what do I need to do to change that? So, without further ado, we have a great podcast lined up for you today. Really, really amazing interview with somebody who's doing amazing things. I'm excited we were able to get him on the show. So, Arn Cenedella is our guest today. He's the founder of Spark Investment Group, real estate expert, over 35 years of real as a realtor navigating the unique real estate landscape in Silicon Valley, California. So he's had some really amazing experience there. He's in recent years, he's taken his passion for helping others, achieving financial freedom, and investing into the multifamily syndication world. Arn now currently manages and operates a multifamily portfolio as a general partner and sponsor of over 1,100 units. So 1,100 units with a total value in excess of $138 million. In addition, he's also a limited partner in over 500 units located throughout the Southeast and the Mountain West. So as I said, he is the founder of Spark Investment Group, where he puts together all these decades of real estate experience to help his clients reach their financial goals and attain the lives that they want to live. So without further ado, let's get right into our interview with Arn Cenedella.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Arn, welcome to the show. How are you feeling today?
Oh, Peter, feeling good. Pleasure to meet you, and look forward to discussing, chatting about our favorite passion and pastime, real estate investing.
Right. Well, I love how you said that, because I feel like sometimes real estate is a means to an end for somebody, for some people, and we probably have that in common, where it's more of a passion, and you probably enjoy a lot of the different aspects of the business, maybe more so than most. I always love having conversations with people like that, than the people who are just kind of, they're doing it because of the money, or because of financial freedom, or whatever you want to call it. So
Yeah.
but Arn, before we hop into the conversation, just introduce yourself to the audience in your own words.
Yeah, so my name is Arn Cenedella, and I'm 70 years old and still doing real estate. Typical middle income, middle class American kid, grew up in the San Francisco Bay Area. Parents, of course, said, do well in school, study hard, go to college, get a degree, did all that, ended up with a master's in physical chemistry of all things from the University of Michigan. Never did anything with it. Returned to the Bay Area and went to work for my father in his residential brokerage business in Menlo Park, California, which is basically next to Palo Alto. And I was there as in more from an agricultural area into Silicon Valley, and of course was the beneficiary of appreciating prices and kind of what's happened in the San Francisco Bay Area due to tech. Single family broker, started building a single family portfolio. Probably like many of your listeners, bought my first house when I was 26, lived in it
Nice.
4 or 5 years. Started making a little more money, could afford something a little nicer neighborhood. Moved, but I kept my first house as a rental, and that was my first rental, and then started building up a single family portfolio. My father was a single family investor too, and I just kind of followed in his footsteps. About 10 years ago, Laura and I moved across country to Greenville, South Carolina. And about 5 years ago, I made the decision to transition from single family investing to multifamily. And now I'm kind of a multifamily investor and syndicator.
Wow, there's a lot to unpack there.
Try to go through it quickly, but that's the highlights. Yeah.
No, that's I'm sure, yeah, it's a unique story to you, but a story that I'm sure a lot of people can relate to. It's you followed a path that I feel like a lot of people take. And I'm curious, were you continuing to manage properties out of state when you moved, or did you just say, all right, let me let me not fire sale necessarily, but let me sell off, the single family portfolio, move, and then, get into multi, or how did that kind of transition happen?
Yeah, so that's a good question. So initially, I started investing in the San Francisco Bay Area where I lived. And again, this is back, I started in 1978. So this would have been late 70s, early 80s. And at that time, you could actually still buy single family rentals in the Bay Area, which these days, where the average price is 2 million, probably doesn't work too well.
Yeah.
So those I managed myself. I had the good fortune to kind of get turned on to Austin, Texas
Okay.
around 2000, and I started buying single family and duplexes in Austin, Texas. Those I had third party property management. And then when I moved to Greenville, I solely liquidated my portfolios and kind of moved the equity to Greenville and
Mhm.
continue to manage the properties myself. And had the good fortune to meet a person who became a friend, property manager Brian Walsh, who's now my primary partner. Uh, Took me a while to wise up to it, but ultimately I turned the property management over to him of my single family and small income properties. And I did okay, but he's a much better property manager than me. And when I turned him over to a professional property manager, I kind of went, why did it take me so long to figure this out? So we ended up building a relationship. And as I started thinking about multifamily, uh, and I'm basically a syndicator, so we pool other people's money, passive investors, to buy uh, apartment buildings. Uh, I knew I wasn't a fabulous operator, and it's one thing to self-manage your own portfolio, but when you deal with other people's money,
Yeah.
you have a higher responsibility.
Sure.
Looking at myself realistically, I knew operations really wasn't my thing. I can find deals, I can talk to investors. I love kind of the hunt, but I knew I wasn't the operator. So it took me about a year of literally courting Brian, who was also a single family guy. Single family investor, single family property management company. And I started talking to him, educating him about multifamily. And it took me about a year, and finally, we found a property we liked, not real huge, 43 units. We actually kind of like the sub 100 unit market.
Mm.
Uh, and we closed that first deal. And since then, over the period of the last 4 or 5 years, we've probably done 8 or 9 other syndication and joint venture multifamily deals. But it wasn't until I had found the right partner that I felt confident to proceed. And I know you have kind of a team, and I'm
Sure.
sure you each are strong in certain areas, and the total is stronger than the parts, right? You formed that
Yeah.
good team.
That's a great way to put it.
That's kind of how we did it, and it's working great.
Yeah, I think that's such an important thing for people to realize in the real estate world. I always like to look at it as there's capital, acquisitions, and execution, and everything you do kind of falls into one of those buckets. And it's very, very challenging to wear all of those hats at the same time. What would you say, Arn, was kind of the personality, or what were the differences between you and Brian? What was it? What was it about him that made him a good, operator, or, property manager, compared to you? Because I think that's such an important thing, like, to be honest with yourself. You know what I mean? And to knowing yourself. I talk about that all the time. It's a big part of Accredited Life. Kind of the community behind this podcast. When you know yourself, and yourself, and who you are is aligned well with what you're doing, it's going to make your life so much easier. And it sounds like you figured that out, and it sounds like it's made your life a lot easier. So that's a great, I'd like to talk more about that.
Yeah, so it's a great question. So sometimes in business, your listeners may have heard of the terms visionary and integrator. Okay. The visionary's the person who's got a million ideas or going 1,000 different directions at once. Their desk is messy. You should see mine. It's a rat's nest. The integrator is actually the person that makes the business go. And what I found with property management, asset management, and he also handles unit turns and unit renovations. And I know you do a lot of construction work too. Those you need systems and processes to follow. And so he's very much a systems and process guy, policy and procedure manual. And of course, when you're dealing with the leasing of properties, there are fair housing laws that need to be followed. And to the degree you have a system and you implement that system repeatedly, you're going to be following the law and doing things the right way. So he's very steady, system oriented, where I tend to be a little more mercurial. And I'm a little impatient. I don't like getting bogged down in the details. And I have one other partner that we brought in about 2 years ago, and he's kind of the brain, the spreadsheet guy, the financial accounting guy. And he's also an integrator. He's very much by the book. And and very steady. And, in working with partnerships, you're going into a deal. Somebody's going to feel excited about it. Maybe your partner has doubts, and you got to kind of pick each other up and talk through. I find the different mix of the personalities really helps. And essentially the way we work, I'm inclined to say yes. They're inclined to say no. And we only proceed if we all say yes. And while that can frustrate me at times, I've learned to trust their judgment. So if I get an idea and it makes sense to them, then my confidence level goes up that we actually have something worthwhile bringing to our investors. So it's a very interesting mix. And I'm thankful I found them because they handle the stuff I don't like handling, which frees me up to kind of do what I want and do what I'm good at and what I enjoy. Usually, it's funny how it works. Usually what you enjoy is what you're good at, right? Sure. And vice versa. And so if you have a partnership and you can play to each other's strengths, that's how you kind of form a winning team.
Yeah. Wow. That is, and what are you good at, Arn? What do you like to do? I'm curious now.
I'm kind of,
haven't said it, but
yeah, I'm the deal finder. I'm kind of the front man. I talk to investors. I'm busy on social media. And it's probably similar to your business. We have one market, Greenville, South Carolina, where we live, and we know, and I think it's important as a realtor, it may be a little bit old school, but kind of local market knowledge is an investor's competitive advantage. So we only do Greenville County, about 500,000 people. The region's called the Upstate, about 1 million. So it's a relatively small market, but within that market, we've bought stuff 7 units and 281 units. So we'll try to do the gamut.
Wow.
We own assets that were built in 1970. We've also recently bought some new build, smaller projects. So our real constraint is geography. And within that geography, we're happy to take on a variety of size, type, age properties.
Yeah. Wow. I love to hear that, because a lot of times with multifamily syndication, it's been such a booming industry over the last few years. There's so many people in that space. I'm always curious to what is the competitive advantage. And I know from my personal experience, like you said, like our office is based out of Philadelphia. We do a lot in Philly, but we do even more in Baltimore, which is sure. I was just there the other day. It's an hour and a half ride down. Especially if you leave, you beat the traffic. So you can get there. You could be on site, all that kind of stuff. And I'm always curious. I have friends in this area. They go down south, because it sounds good, and then there's migration, all that kind of stuff. And I'm always curious to what the hell is your competitive advantage when you're from around here and you're going down and doing that. Now, I think if you have enough scale and you can do certain things with your team and stuff like that, I see it. But I love what you're saying where, you have a buy box. You've identified this market that you like. And then within that, you're flexible with unit count and things like that. So tell me about that side of the business, Arn. Like, what do you, are you, is it relationships with brokers? Are you calling owners? Are you driving around? You doing a little bit of everything? Tell me how you're finding deals.
Yeah, yeah. Of course, that's the $64 million question, and it all starts there. And then, of course, we all know ultimately it's the operations that are going to make or break the deal. But it all starts with finding opportunities. So,
Mm,
network a lot with the brokers. Um, Network a lot with local investors. Greenville is a relatively small town.
mm,
Do a lot on social media. And so other real estate people in the greater Greenville area or the upstate of South Carolina would be the region. They kind of know my company, Spark Investment Group, likes buying small multifamily properties. And so once you kind of get a niche or a reputation, people know. And what it sounds like, even though for you, Baltimore's an hour and a half away, you've done enough deals in that market that you have your team there, and the players in that market know that you're a buyer. And so it's like you have to kind of reach a critical mass
sure.
in a market to really start gaining some headway, and then the momentum builds. And I think your listeners are probably aware some multifamily syndication deals recently have got into trouble,
Mm,
and generally they're going to be based with floating rate bridge debt,
mm-hmm.
and often the ownership group is not local. They're 2 or 3,000 miles away. And it's just problematic. Like in your community, in my community, I could be on a street and it's a great street. You could go a half mile away and the character of the neighborhood could totally change, right?
Oh,
Right?
in urban areas, you can go, you could
Block
throw.
by block. Yes, yes. And so looking from afar on the map, it looks like, oh, those are next to each other. It's got to be the same.
Yeah.
The other thing about local is what I look for a lot is where are people starting to flip houses?
Mm-hmm.
Because typically they're going into a little bit lower priced area, right? They're not doing flips in the country club area, or I don't know what the word would be, but they're doing more in the low
Yeah.
entry level. And so you start seeing flippers in there, that area is on the improve. Or if you see a place where an old storefront's being turned into some cool coffee shop, again, you kind of get a sense
Yeah.
there's going to be some positive momentum there. And you really only get that by being there, seeing, hearing, and feeling what's kind of going on. So, for me, investing, I think really drill down, niche down is much better than spreading yourself too wide.
Yeah. That's amazing. I love what you're saying there. What brought you to South Carolina, to Greenville originally from
Yeah,
California?
yeah, great question. So, both Laura and I basically spent 50 years of our life in the San Francisco Bay Area. Laura had a great tech career. working with Intel, Visa, and Intuit. Not that she was a techie, but she worked for some fabulous companies, and I did real estate there. Bay Area is a great place, awfully expensive, awfully crowded, awfully busy. And so I'm now 70, Orr's about 60. And so we were looking for something different. Kind of got onto the Carolinas and thought we were going to move to Charlotte, which is 90 miles away. Basically, Greenville's between Charlotte and Atlanta, smack dab in the middle, 90 miles one way, 120 the other. But when we found Greenville, it had a great downtown. We live in a historic neighborhood, 1 mile from downtown. We can walk. There's minor league baseball, 100 restaurants, a river, a waterfall, and we're in the Blue Ridge Mountains, so there's a lot to like.
Yeah.
And we moved here for a lifestyle change, and it's met or exceeded our expectations. And then, of course, coming from California, from the Bay Area, everything looked cheap, and it looked like a good deal in terms of the real estate. So I just started buying houses, and there is a strong economy here. BMW is here. Every X car they make in the world, which is their four-wheel drive vehicle, every X car BMW makes in the world is built in Greenville, Spartanburg. Sounds strange, but it's true.
Yeah, I didn't know that.
Michelin North American is here. GE and Lockheed's here. So we've got some good manufacturing. It's kind of a moderate climate. So we just happen to stumble on. It works for us, and we're happy we found it. I can tell you, our friends back in the Bay Area thought we were a little crazy. Moving to South Carolina,
Yeah.
do they have internet there or, whatever? And so anyway, it's all worked out, and we've been here now basically 10 years in about a month.
Wow. Okay, that was. I knew you had said it. You kind of got there before it was cool to move there too. You're really a trendsetter. There's been a lot of migration last couple years, or what?
What's that?
Has there been a lot of migration? Have you seen a lot of new people moving in?
Yes, population growth is going, and as an investor, you look at population and job growth. So we have a lot of people moving from New York, Boston area down, and of course, they tend to be on the wealthier side. They have equity in their home, so they're bringing wealth and income, which provides a lot of jobs in kind of the service industries and so forth. And South Carolina is kind of a landlord-friendly, business-friendly environment. So it's interesting. The last couple years, South Carolina has maybe been number 4 of the 50 states on in-migration. And the 3 states they've been behind are Texas, Florida, and North Carolina. And of course, those states are 3, 4, 5 times larger than South Carolina. So on a proportionate basis, the in-migration is very strong. And I would say kind of the factors that brought us here will attract other people. So I like the market, and I'm optimistic about its future.
Yeah. How has that in-migration evolved the deals and your underwriting and all that kind of stuff? I'm sure rents have skyrocketed, and I'm sure developers are bringing new units to market and that kind of stuff. So talk to me about that.
Yeah. So like most areas, I'm trying to reflect back. 2021, 2022, rents went up dramatically. I would say we maybe had 2 years of about 15%. And then, of course, somewhere mid 2023, Q3 2023, rents started to level off. So rents have maybe dropped a little bit. There is a lot of capital investment in Greenville. Developers from Charlotte, Miami, New York are here. There's been a lot of Class A kind of luxury downtown apartments being built. And honestly, there's probably a little bit of overbuilding, and it's going to take some time to absorb that. the rents for the new downtown luxury apartments kind of range from 2,000 to 3,500,
Mm.
where the stuff we do is not downtown, it's garden style, either 1 or 2 story units, and our rent rates are like 1,500 a month.
Nice.
So we're not really competing with the luxury apartments. We have less dense properties. People have dogs. A lot of our units have yards and so on and so forth. So it's been a little slow down the last 2 years. And what we focused on in 2021, 2022, into 2023, every time we got a vacancy, we were able to increase rent.
Mhm.
By the middle of 2023, we knew that was no longer in the cards. So we just basically tried to maintain occupancy,
Sure.
hold rents flat. And across the portfolio this year, we were probably at about 96.7% occupancy. Again, our rents are affordable. We're responsible landlords. We take care of our properties. We take pride in the property. So things have gone good, and been in the business 46 years. And I've been through several market cycles. And if I had a crystal ball, I would say kind of we're at a plateau. We've had a little bit of a correction after about 7, 8 boom years from 2012 to
Yeah.
2022 is boom. We've had it do natural and logical, a little correction. But of course, the correction is small compared to the boom.
Sure.
Now I think we're at a plateau where I expect maybe in the next 12 to 18 months, the market's going to take a turn up. Hopefully rates will drop a little bit. I think that will spur it. So I think kind of we've gone through the worst. I'm optimistic, and I think the real estate market will continue to get better in the near future. And kind of in my mind, when the market turns, in my experience, it generally turns very quickly. Everybody kind of jumps in the bandwagon. And in multifamily, we hear about dry powder, meaning there's a lot of capital on the sidelines waiting to pounce. So once everybody starts to pounce, now you're back in a competitive situation.
Sure.
So for me, I'd rather be 6 months early than 6 months late. So we're still an active buyer. We closed a deal about 2 weeks ago, 38 unit value add deal. Don't have anything in the pipeline, but that's what I spend every day looking for. So
Yeah. So, well, tell me then. So, what's kind of an ideal? Is there, or is it Class B? Would you say? Is it C? Is it kind of flirting in between, or? And then, like, what does occupancy typically look like? And how are we? Which ways do you like to add value? Is it a little bit of everything, or look at operational, looking at adding to the units in some way, or from a finishes perspective? Talk to me about that.
Yeah, so it varies from property to property, our approach. And honestly, these days to kind of do let's call it a cosmetic upgrade, new countertops, new flooring, which typically we do LVP, luxury vinyl plank, paint, new fixtures, something like that might run now about $6,000 to $7,000 a unit just to get kind of new coverings on the building. On other units, we're spending as much as $20,000 a door, and that's going to more involve new cabinets, granite counters, new bath, pull the old tub, go back with the acrylic. And then, of course, there can also be operational improvements. The building we just bought was owned by a gentleman who's about 60 years old. He inherited the property from his parents. So that means that family's owned it 30 years. And as you know, long-term owners paid next to nothing for the property. So they own them free and clear. They're not real aggressive about raising rents because of the things that cash cow anyway.
Yeah.
So on that one, we just think kind of, and the owner was the type guy that kept the rent roll on a piece of paper and pencil. Okay, that's how he did it. Okay, and nothing wrong with it. With people,
Did he at least
name
leases?
yes, but most of them are like month to month, so it's crazy. But the rents are below market, and so we'll just get in, and what we like to do is raise rents incrementally. So we might raise them $50 for 6 months, another 50 the next 6 months.
Yeah.
Because you want to be respectful of people. It's their home. You want to try to bring the rents closer to market, but you can do it in a cooperative, gradual way.
Yeah.
And so you all know, vacancy and turnover cost are two of the big expenses for owners. So if you can minimize that, that's a win. And then on the other hand, if somebody wants to leave, that's okay too. Then we got a vacant unit. We're going to put 7 or 8,000 in each of these units, and then we can bump the rent from 6 to 800. So it's kind of either way, we're going to be okay. We incrementally raise, or we vacate and significantly raise. Yeah, he's mom and pop. So operational improvements there, and then we do the value add just as needed.
So talk to me about the structure of the deals with the investors. You said it's mostly syndications, and did you do some joint ventures too, maybe? Or so speak to me about that. And then are these typically properties that you're going to stabilize and sell, or do you want to refi and continue to hold? What's that look like?
Yeah, good question. So basically, we're a long-term investor. We haven't sold any because we went into the multifamily 2021. So a lot of our assets have 4% fixed rate debt on them. We got another 3 or 4 years to go on it, so there's nothing really to kind of do. And what was the first part of your question, Peter?
How do you normally structure with
yes.
It's syndication, and just curious, and I don't know if it's 506C or B, how much you can say, but
Yeah. So we generally do 506B syndications, which are open to accredited investors, but also so-called sophisticated investors that have a prior relationship with a sponsor like me. Most of our deals tend to be 4, 5, 6 million. So our capital raise is typically $1.5 million up to about 3 million. And at that level, you can actually make a 506B work.
Sure.
If we were buying $50 million properties and need to raise 20 million, you almost have to go 506C, accredited investors only. There's no other way to do it. Our typical kind of setup with the limited partner investors is we pay them a 7% pref, and then we split the profit above the 7% pref on basically a 75-25 split. So the limited partner investors get 75% of the profit. The general partner team gets 25% of the profit after the 7% annuals paid off the top. And the nice thing about that structure, and it's very typical for the limited partner investor, is most of the compensation for the general partner, the sponsor, the operator, the terms are used interchangeably, is at the back end.
Sure.
And solely based on performance. So if they get a deal and they hit it out of the park and we increase the value of this property $2 million, well, there's a nice big pot to split between the limited partner and that. If we don't do as well, the pot's smaller, and so we make less. So our compensation is directly tied to how much money we make the limited partner investors. And then just the one other clarification is nothing in real estate's guaranteed. So,
Sure.
So the 7% pref is not a guarantee. I'm not Uncle Sam. It's not like you're buying a T-bill. but what it, and I'm joking kind of, but what it means is the limited partner investors gets that first 7% annual return before the general partner gets $1,
Yeah.
right? If that makes sense.
Yep.
And that's nice because today, investors can put money in money markets, 4.5, 4.75. So if you pay a 7% pref, they're highly likely to at least get that, plus the potential for a share of the profit. And uh, typically these are kind of underwritten for 5-year holds.
Okay.
But of course, as an investor, you know, you just have to adjust to market conditions,
Yeah.
right? Interest rates, cap rates. If on one of our assets, some buyer from California, let's say, who has a bunch of money in a 1031 and needs to find something,
Yeah.
and they'll pay us 20% more than the property's really worth, we might sell it after year 3. Does that make sense?
Sure.
Right. So if we did an attractive offer, and the guiding principle is always what's best for our investors. And as long as we follow that, and that's the focus and the basis for our decision, then we're kind of meeting our fiduciary duty to them. The other thing I think is we have a lot of repeat investors. And so I think as an operator like yourself, to the degree you perform for people,
Mm.
they become investors for life. Because
Sure.
if you've proven yourself over 2 or 3 transactions, you come up with another opportunity 2 months from now, they already know, yeah, these guys do what they say. I've made money with them. I'm happy to go in. So kind of building that trust and that repeat referral business is important.
Yeah, without a doubt, and raising capital, as much as some people want to make it seem easy, it's typically not, and the internet's made it where people are more accessible than ever before. You'd mentioned a few times, you do a lot on social media,
Yep.
but the competition, there's no barrier to entry, right? Anybody can set up a LinkedIn or Facebook, and now doing this for 10 years, now more than ever. I like to think like raising capital is almost like the new fix and flip. It's like you can go to a weekend seminar and you could be a fund manager, raise capital, right? So it's there's competition in the space, and so you really, like you said, you want to do what you say you're going to do. You want to perform because it's hard to find new investors. It's hard to compete in that sense, and also you don't want to lose the people that you have, and it's always great to get reinvestment from somebody who's already been in and all that kind of stuff.
Yeah. And if you have an investor, Rick, and Rick tells Joe,
Sure.
Peter's the real deal, invest with Peter, Rick's putting his name to you.
Yeah.
So there's an extra added level of responsibility, one to the investor, but to your friend and prior investor who vouched for you. So in my mind, it's a great way to do business. And I think most people, when they get into the business, they kind of start with friends and family, have a little success,
Hmm.
then they start to develop a track record, people refer, and then the snowball starts to build, and
Yeah.
that's how it's been for Spark Investment Group too.
Yeah.
Yeah.
Well, that's kind of a great transition into, how can people find more about Spark and more about you and your team?
Yeah, so active on social media. LinkedIn and Facebook are the 2 major ones I use, either under Arn Cenedella or Spark Investment Group. And my website is investwithspark.com. A lot of educational information there. I have probably 30 or 40 podcast recordings, probably 100 blog articles, and it kind of educates people as to the syndication process. Easy to reach out, schedule a call, and that's how it kind of starts. No obligation, no pressure, just happy to answer questions.
That's awesome, Arn. Well, I greatly appreciate your time. This was a great conversation. I love what you guys are doing on a lot of different levels. So highly suggest anybody to reach out, have a conversation, see where it goes. But thank you so much for your time, Arn.
Hey, Peter, pleasure. Glad to help. And hopefully we'll cross paths again.
Definitely.
All right. Thanks.